Yeah, so comparing tax gains to market gains. If your top tax rate is 37% and we can move that down to 20% based on the nature of your timing or the nature of your type of investment or the structure that it's in, that's a permanent 17% on that income. And
Yeah.
so if I can do that and also get you market returns, that's a double leverage. And
Well, and
so,
that seems like that's 17% per year. When I quoted that former client that their portfolio was doing like 17, 18% over a 30-year period,
yeah,
uh, there were some years in there that were absolute dog crap.
sure.
But if you're able to do this with tax, that's, I'm assuming, less sensitive to market conditions.
It's less sensitive to market conditions and more sensitive to how you're earning your income in that particular year.
Yeah.
Because income tax is the largest of taxes outside of estate tax, and estate tax is usually deemed as an elective tax. So if we can do proper planning at the right time, we can lock it in where you're under that cap. We can't control the laws or when they change or that kind of stuff, but we can do as much as we can more easily on estate tax than you can on income tax because at some point, some different types of income are just going to occur in the year, and it's beneficial for you. It's great, but it will come with a tax challenge. So anything that you can do to peel or shave that tax off by changing its nature or the relative investment. If you can convert income tax into capital gain tax because of your contract on the original investment and your payback instead of contract wages, it's just in some other form, stock compensation that you hold for long enough for it to be long term. Anything that you can layer in to reduce that tax in the particular year is one way to add additional gains, in my
Yeah.
opinion.
Well, and then with the money that you save from that, you can go invest that.
Sure. Yeah. Or you can hold it in cash and in, well, like going back to your 40-year-old, if they have an investment that's in a brokerage account and it's taxed as the activity happens, they need to exercise this activity, then they can live on this cash that they've already been taxed on and increase potentially their underfunded 401k. And so that brings them less cash in their paychecks, but gives them the opportunity to use this cash that they've already been taxed on
Yeah.
as a benefit. When you
Yeah.
get out of Main Street everyday America and you're looking at other tax strategies, there are people who will recommend that you borrow against the value of the stock that you own in your multinational company, like Jeff Bezos and Amazon.
Yeah.
There is only one Jeff Bezos, one Amazon. This is a repeatable strategy by someone who owns this particular, but it's a very, very small, limited people who are able to access enough of that growth for it to make sense for them. And when you borrow money, you're committed to the cost of the interest every year.
Yeah.
Is that cost of interest less than a one-time activation of that tax is part of the analysis that needs to be done before you really execute any strategy.
Yeah.
And I hope that there are disclaimers included in this podcast that I'm not giving any advice to anyone in particular. I'm just kind of talking through what might
Yeah.
be
No,
applicable.
and that's, I mean, well, why don't we just go say that